Hi there, welcome to Kneppy Invest. It's been a while since I did the last Kneppy's analysis video, and that was on Technology One to go T and E. And the next company I was supposed to do in this particular series was Universal Store. So here is that video on this company that has been around for over 20 years, but only on the ASX for about two and a half, maybe 3 years. Ticker for this company is U and I. This company owns a portfolio of premium youth fashion brands and omnichannel retail and wholesale businesses. And the most important word there is youth. I have never been into a Universal Store at all. And more than likely, I'll never go into a Universal Store because I am not their market. So hopefully, as we go through this video, you can get a better understanding of what this company does. And even though it has only been listed on the ASX for about 2 to 3 years, it is on the way to becoming a high quality retail company on the ASX, in my opinion. Now, even though I do have a high opinion of this company, particularly the potential of this company over the next 5 to 10 years, even longer than that, I am not a shareholder of this company. And in fact, I have never been a shareholder of Universal Store. Maybe that will change next week, in 1 month, 1 year, or a few years from now. But I do have this company on one of my watch lists. So we'll be paying close attention to how this company performs. Now, when it comes to valuation, that would be my trigger to take a position in this company right now, because I do think there is potential arguments that this company is really good value right now. The current CEO and managing director of Universal Store is Alice Barberry, and this is a work history from LinkedIn going all the way back to 1992 when she was a team leader for Gap in Seattle, United States, and Covent Garden, London. She's also spent time with East Clothing UK, Colorado Group, 4 years with Virgin Blue between 2005 and 2009 as a team development manager. But other than those 4 years with Virgin Blue, she spent the rest of her working life in fashion. So she knows fashion retail back to front, and 18 of those years has been spent with Universal Store, starting back in 2002 as a retail operations project manager in Brisbane. Then in 2009, December 2009, she was named the Chief Operations Officer, and then she remained in that role for 7 years and 4 months. And then in March 2017, she was named the CEO of this company. For the very fact she's almost been in this role for almost 7 years is a pretty good green flag. Not only that, she spent 18 years of her life with Universal Store. So she should know this company back to front. And I actually really like that business model. When you have someone coming through the ranks, being promoted time and time again, and eventually they get to the top position in the company, because that person should know the company back to front. I prefer that model over someone coming in without any knowledge of the company. You see a lot of big companies actually doing that. And the very fact that she's been with Universal Store full time over the past 13 years means there's a bit of stability within the management of this company. And the growth this company has experienced over the last 13 years is, I won't say completely attributable to Alice Barberry, but a lot of this growth in this company over the time she's been in these two roles can be attributed to her. The company's principal businesses are Universal Store and CTC, trading the thrills and worship brands, and they acquired CTC not that long ago. The company is also trialing the Perfect Stranger brand as a standalone retail concept. Now, the Perfect Stranger brand were clothing they were selling in the Universal Store, and they thought because that particular brand, Perfect Stranger brand, was a little bit different than the other clothing they were selling in Universal Store, they thought, why not open these stores that were uniquely focused on that sort of clothing, which is more feminine and dressier than the usual sort of clothing they sell in Universal Store. At this point in time, they only have 8 stores, 8 Perfect Stranger stores, but 5 of those were open in financial year 23, and some nice growth in those stores. They have 10 thrill stores and 77 Universal stores. So overall, they have 95 physical stores across Australia and 3 online stores. Now onto the quality of Universal Store. Now, I can't say Universal Store is a high quality company right now. because it has only been listed on the ASX for almost 3 years, not quite 3 years. And I do want to see a little bit of history. But Universal Store is on the way to proving itself a high quality company. I just need some more data points because we only have revenue growth, not quite 3 years of revenue growth just yet, but we have 1 year of revenue growth, which was 21.5%. Return on invested capital at 12.7. Return on equity is around 18. So when you do see return on invested capital and return on equity above 10, that's actually a good sign that company could be high quality. EBIT 8.3. We'll talk about the valuation of this company later in the video, and that is one of the attractive things about Universal Store right now. It could be attractively valued because one of the reasons it might be attractively valued is because the total return over the past year is negative 33.3%. In fact, over the last 2 years, just after it listed on the ASX, share price has fallen about 67%. So in this point in time, the quality of this company is neither low or high, but I do believe it's on the way to potentially becoming a high quality retail company on the ASX. Now to a few facts in regards to Universal Store. This company was founded in 1999 by brothers Greg and Michael Josephson, and they opened the first store in Carindale, Queensland, which is a southeast suburb of Brisbane, if I remember correctly. And then from 2012, this company rapidly expanded. They opened the first store in Melbourne in that year, the first store in Perth in 2014, and the company's oldest existing New South Wales store was opened in 2013. In 2012, they also launched their first private brand, and today they have 5 private brands spanning women's wear, menswear, and accessories. And from 2015, stores have grown from 31 to current, what was it, 77. Now, the most interesting bit of their history. In 2018, management led a buyout of the Josephson family's shareholding with support from co-investors. Share ownership was also extended to others in the Universal Store leadership team. And because Alice Barbery was named the CEO in 2017, I suspect she led this buyout of the Josephson family. And this company has really grown since this buyout. So I think this could have been a really good thing that Alice Barbery did back there in 2018. The company listed on the ASX 17th of November 2020. So it's about to celebrate its 3rd year on the ASX. The biggest shareholder of this company is Bennelong Funds. They own 14.8% of the company. And at a share price of $3.25, which was a share price at the closing of trading on October 12. I just had to look at the share price right now because I'm recording this video just before trading has finished for the day. And the share price was actually up 6%. That's very important because at a share price of $3.25 with 76.7 million shares on issue, the market cap of this company is $249 million, which doesn't seem a lot when you look at some of the financials of this company, including profit, operating cash flow, and free cash flow. Now on to the financial results for Universal Store, financial year 23, revenue 263 million, profit 23.6 million. Now we get to something really important. Now, I am showing you operating cash flow of 26.1 million and free cash flow of 16.8 million. If you look at the company's reported operating cash flow, you'll see that number over 50 million. The reason why there's a discrepancy between what I'm reporting, the operating cash flow I'm reporting, to operating cash flow the company's report, is because how we deal with lease liabilities. I like to take into account lease liabilities because this company has retail space they are leasing, which is a day-to-day cost in my opinion, because if they can't lease out their space, they can't sell their products. So in my opinion, lease liabilities or leases are a day-to-day expense, and I just take that away from the company's operating cash flow, reported operating cash flow. So that means operating cash flow is only 26.1 million, not over 50 million. And that does make a difference if you calculate some of the valuation metrics, including price to operating cash flow or EV to free cash flow, or any of those to cash flow, EV and price. Free cash flow 16.8, which again will be significantly lower than what the company would report because I take into account leases. That's just what I do, because I want to take into account something that a company needs to pay day to day to maintain their operations. Gross margins, 59. This is where it becomes really interesting. And I'm going to talk about gross margins a little bit more later in the video. And the reason I want to talk about gross margins is because my first thought when I saw gross margins of 59, that's pretty good for a retail company. And I just wanted to confirm that. And I virtually did confirm that. And this is one of the reasons why I think this company could become a higher quality retail company on the ASX, just because of the gross margins and also because the retail or return on equity and also return on invested capital. Equity at the end of the financial year, 136.4 million. And that's how I calculate return on equity and that sort of thing. And one thing I'd always keep an eye on is equity. Is equity growing through time? And you really want to see equity growing through time for any type of high quality company. So let's talk gross margins right now. I was intrigued by the gross margin of Universal Store. Now, it's not quite as high as Lovisa, but I did not expect it to be as high as Lovisa. And if it was as high as Lovisa, I would have been going all in and buying as much shares as I could of Universal Store. But this is from Guru Focus. Well, gross margin in this particular industry. So I'm comparing apples to apples or like to like. So I just wanted to see what the typical gross margin is for a retail company, particularly a discretionary retail company, particularly a discretionary clothing retail company. And where we see the gross margins for this company is at the high end. If you look at the median gross margin for this type of company, it's around about 35%, not 58%. So this company is at the high end of what you would expect. And to me, that is a signature of a potential high quality company or a company that is already considered to be high quality. Now, that Guru Focus chart, information, research is only one source. I wanted a second source to confirm what I found via Guru Focus. And I found this particular article on the RBA website titled Competition and Profit Margins in the Retail Trade Sector. Now, it is a little bit old. It was released on the 20th of June, 2019, written by Matthew Carter, but this does give a good idea what you should expect gross margins to be for these type of companies. Now, he split gross margins into food and non-food. Now, this particular graph called Graph 5, Components of Retail Net Margins, he's broken it down into gross margins, which is what we want, and cost of doing business. And what he found in non-food sector or non-food retail companies during the period between 2007 or 2005 and 2019 is that gross margins were dropping during that period, which is why, and the whole reason he wrote this article is why net margins were actually dropping for retail companies over this 15-year period. And in 2019, he found that gross margins in the non-food retail sector in Australia were roughly 35%. Lo and behold, almost identical to the median gross margins found by Guru Focus. And again, when you compare the gross margins of Universal Store, 58%, to the typical gross margins found in this particular industry, 35%. That's a good sign, not an absolute sign, but a good sign about the quality of the company. So I think that's why I might consider Universal Store to be a higher quality retail company, not only on the ASX, but in Australia itself. Now onto the statement of cash flows. And the only reason I really want to show you this is to drive home the point that sometimes you do have to take into account lease liabilities, particularly for retail companies. So the reported cash flow, operating cash flow by Universal Store was $51 million, which is sort of ridiculous when the markup of this company is $250 million. So that means the price operating cash flow of this company is around 5, which is way too low. So the lease liabilities for Universal Store, which is found in the financing activities, was $24.9 million in financial year 23 and only $20 million in financial year 22. It's an ongoing cost. This company has to pay the leases to sell their products, and that's why I include it in the operating activities. And the other reason I like to include in operating activities is I want to be a little bit more conservative when I am calculating valuation metrics. One of the first things I look at when I am beginning my research of a company is revenue history, preferably 5 to 10 years, at least 5 to 10 years of revenue history. And the thing I want to see is revenue increasing through time. The main reason I want to see revenue increasing through time is because if a company can't increase their revenue through time, then how the heck are they going to increase their profit? Because the only way a company can increase their profit if they can't increase their revenue is by increasing their margins or decreasing their costs. But the thing about increasing your margins or decreasing your costs is that's unsustainable for the long term. While revenue growth can continue infinitely, can continue for the next 100 years. A company can literally grow their revenue for 100, 200, 1,000 years. A company can't increase their margins and decrease their costs for that amount of time. So the most powerful way to grow your profit through time is by growing your revenue. So that's one of the reasons why the first thing I look at is revenue growth. But unfortunately, Universal Store has only been a listed company for 3 years. So we don't have all the information we could if they had been a listed entity for more than 10 years. But fortunately, the company provided some information in their financial year 23 presentation or their annual report. So they provided the last 4 years of history when it comes to physical stores, like-for-like sales growth, revenue, and underlying EBIT broken down in half years. And it's really interesting that they did break down revenue and underlying EBIT into half years because we can see just by them doing that, there is some seasonality to this company, which I'll talk about in a second. Now, they are growing their physical stores. And this is very important for me. Now, they are growing their physical stores through acquisition and starting that perfect stranger store thingy, whatever you want to say. So they're growing their stores from 65 in 2020 to 77 presently. Like-for-like sales growth have been all over the place over the last 4 years. 28.5% in 2021, down to negative 3% in 2022, back up with 1.2% in financial year 23. So ideally, you want to see like-for-like sales growth above 1%. It's a very important metric when it comes to retail companies. Now to revenue. And the most important thing is revenue is growing from year to year. There was a slight blip in 2022, revenue only down 3 million. But the other interesting thing here is because they've broken down revenue into half years, you can definitely see some seasonality. So this company is just coming out the worst half year. So this company's best half year is the second half, which makes sense. People tend to buy more stuff in the second half of the year because of holidays. But the main thing here is over the last 4 years, revenue has grown from $155 million to $263 million, and EBIT or underlying EBIT is also growing, up from $25 million in 2020 to $40 million in 2023. And for those income seekers, there is a dividend here as well, and not a bad dividend. In fact, the dividend yield of Universal Store right now is 6.4%, which is attractive for a company that is growing. And there is potential if they keep on growing from here, that dividend will keep on growing as well. In fact, it should keep on growing, which means if you buy some shares in this company right now, that dividend yield on your initial investment might exceed 10% within a few years, might exceed 20% in about 5 years, maybe even more. So the thing I look for when I am researching a company is I want to see dividends growing through time or increasing through time. That's also a good sign of a high quality company. As soon as I see a dividend of a company going sideways or even decreasing through time, I just say straight away, that's a low quality company. So only 3 years of history for Universal Store, but it is on the right track. Dividends are increasing, maybe slowly, but they're definitely increasing over the last 3 years. Now we're on to valuation metrics, and this is where it becomes really interesting, particularly those who are value investors, because it could be argued there's some really good value in Universal Store right now, particularly when you look at P/E ratio, price to operating cash flow, EV to EBIT. All those valuation metrics seem quite low for a company that has growth potential over the next 5 to 10 years. P/E ratio 10.6. Price to operating cash flow, 9.5. And I think the market is saying right now they are skeptical that this company can grow over the next few years, which is understandable. But what about next 5 to 10 years? I think just if you had that long-term view of this company, there might be some value in this company right now. Also did a reverse DCF. What will this company have to grow their earnings per share to justify their current valuation? and only 4.1% over the next 10 years, which is definitely achievable for this company. But I just think the market right now is a little bit wary about the next year or even 2 years. So that's probably the only reason why some of these valuation metrics are or seem quite low right now, is because of that skepticism by the market. One other thing I love to do when I'm researching a company is look at the P/E ratio history or any sort of valuation metric history of the company. I just want to compare the valuation metric of a company now to its usual historical range, because that's how you can determine whether a company is cheap or expensive. Just look at the historical range of that valuation metric. So here is a P/E ratio of the Universal Store going back to July 2022. So we only have 2 years of history for this company. And the reason it only goes back that far is because that was the first time Universal Store released full year results. And what's really interesting, from that time, July 2022 through to about March, April 2023, the typical PE ratio of this company was between 14 and 19. But ever since March, April of 2023, so not that long ago, 6 months ago, the PE ratio now has been ranging between about 13 and as low as 8. So at 10.8, you could argue that this company is attractively valued just by looking at this PE ratio history of the company over the past 2 years. But this is why it's really important to have at least 5 years of history, preferably 10 years of history, because then, for instance, if Universal Store's PE ratio right now was as low as it's ever been over a 10-year period, that would be a good sign that potentially the company is attractively valued. Now, there might be some other reasons why the PE ratio might be really low, but it could be just a sign that the company is attractively valued. Now to the chart for Universal Store. This is the daily chart from when they listed on the ASX. And the first year as a listed company on the ASX was great for this company. In fact, the share price more than doubled from the end of 2020 to the end of 2021. And the share price has completely tanked since then. In fact, the share price got to a high of almost $8.60 in October 2021. And the share price has been as low as $2.50 in June 2023. Share price has rebounded since then. Now, it's really interesting that the two lows we have seen, and it's only a sample size of two, have been in June 2022 and June 2023. Now, the June 2022 low can be explained by overall weakness in the market. That was the overall low in the ASX. Not sure we can say the same thing about the June low in 2023. Potentially, the reason why we see lows in the share price of this company could be because of seasonality. I just don't know. But when you do look at this chart, particularly if you focus on the most or over the last year, the share price is still in a downtrend. Now, when it comes to high quality companies, I'm not as concerned about trends in the share price. The main thing I'm looking for is valuations. Do I see good value in the company at current prices? Now, because I don't necessarily consider Universal Store as a high quality company just yet, I need more data points before I determine that. But I think it could be considered a high quality company in the future. I am interested in this company right now just because of valuation reasons, not because of the chart. I plan to continue this Kneppy's analysis series as long as possible. Who knows when it's going to end? I've already figured out the next 5 companies I'll be doing in this series, and they are Perseus, Dusk, Macquarie Technology Group, WH Soul Patterson or Washington H. Soul Patterson, and Aristocrat. If you have any suggestions of companies you'd love me to do in this particular series, leave those suggestions in the comment section of this particular video, and I'll see what I'm able to do. Some suggestions I'll probably say no, some suggestions I might say yes. It's all dependent on my mood on the day and whether that company is a good company to feature in this series. That's all I have for this Kneppy's analysis of the Universal Store. If you have anything you'd like to mention about this company, if you disagree with me about anything I mentioned within this video, I'd love to hear your reasons why, your thoughts, your questions, that sort of thing. And one of the reasons why I like to hear different opinions than my own is because the way I grow as an investor is to maintain an open mind, is to listen to different thoughts, different opinions than my own. And I think that's one of the most important characteristics to have, not only as an investor, but as a human being, is being open-minded, being curious, because that's how we grow as people, as investors. So leave your thoughts, your comments, whatever, in the comment section of this particular video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.